The most common ones you might think about, okay? Well, I'm living in one unit and I am renting out the other unit. All right, so if you're doing a sale for somebody selling a duplex and they're living in one of the units, they can use code 121 for their portion and code 1031 for the difference. Now, what's really interesting is, and I'm going to get to this in a second, what's been really interesting, I'm going to do this without anything falling, all right. Success, okay, is that, see that revenue procedure 2005-14? All right, in that revenue procedure, what happened was that the IRS said if a taxpayer has a property that used to be their principal residence and they were out of the property no more than 3 years, they could qualify for 121 and 1031 treatment. I had a transaction. Okay, they were selling for $1.5 million up in Palos Verdes. Okay, I'm going to just say there's a zero basis in the property. This property was a rental for 2.5 years, so they were running out of time for that 3-year out of the property. The owners of this property said, I'm not sure if I really want to sell this property because I only get how much? $500,000, right? So that means, and let's just pretend that their basis is zero. So say they're going to pay tax on $1 million. They go, I'm not sure if I want to do that. I said, well, you can do both. He says, what do you mean? I said, well, you can take $500,000 under code 121, tax-free, and then you take the $1 million and you 1031 that into another property. So you buy a property for $1 million or more. So that way, that opened up that listing for that agent, because what ended up happening in that situation, he says, okay, I can live with taking $500,000 tax-free and then put the rest into another property. That is something that if you understand how this works when you're working with clients, that it might have been their primary residence and they're out of it, they can do both. They can do both. Okay? And it's not uncommon. It's not uncommon. So knowing this is really important for you as agents when you start to work with high liability properties or high income properties. Okay, remember I was telling you about the exchange train and people were exchanging and moving into it and selling? All right, in 2004, they changed the code, the tax code 121, and it read like this. If you acquire a property that you exchanged in as a part of an exchange, and you later convert that property to your primary residence, before you can sell it and get the 121, the 500 or 250,000 tax-free, you not only have to live in it for 2 years, but you have to own it for 5 years. So those people that were renting it for a year, moving into it and doing that, it put the brakes on it, on that one. But you have to own it for 5 years. You have to own it for 5 years. Now, they never stopped tinkering with the tax code, all right? So, another thing that just came into effect in 2009, it says, if as an investor I move into one of my investment properties, okay, and say it wasn't even a part of an exchange, I'm just moving into my investment property, because that's how people can sell an investment property and not have to do a 1031. They make it their primary residence. Going forward, from 2009 going forward, if it was a rental for 3 years, I live in it for 2, okay, so I've met my 2-year requirement, and say I have $500,000 worth of gain on the property, just keep the math real simple, I don't get the full $500,000 anymore. I get a proportionate share. I only spent 2/5 in that, so I only get $200,000. See what they just did? Okay, because the last use of the property was the principal residence. Does everybody follow me on that? When it used to be an investment and you converted it to your primary residence, from 2009 going forward, you're going to get a prorated share of the of 121 tax-free treatment. Yes?
Even though you owned the whole thing for 5 years?
Yeah, because we're talking 2009 going forward, right. Okay, going forward. So nothing, not going backwards, but going forward. And we're in 2011 right now. So, people are, go ahead.
When you say own for 5 years, do you mean free and clear, or that
What I mean when I say, the question is when I say own, does it mean free and clear, or is there debt associated with it? It means I'm on title, whether I owe somebody or don't owe somebody. I'm the owner of that property, okay? Me and my bank might be partners, okay? All right, but the reality is, no, I'm on title to the property.
So what about if I'm living there, investment property for 5 years then?
Mm-hmm. Okay, for 5 years, then you're fine. You should be fine on that one. But it's when you have the years that you have to be careful of. If it was an investment for 3 and I lived in it for 2, which clearly makes me meet the code for 121, I just don't get the full $500,000. Now here's the genius of the people that write these laws. Okay, if I move out of it for a year, I get the full $500,000. Now you go explain the logic to me on that one. I don't get it. All right, so it's the last use that's going to trigger that. So if, for example, I'm dealing with, say, 3 years of rental, 2 years of primary, and I move out of it for a year, I get the full $500,000 because I'm not living in it at the time. I know, I get it too. She's looking at me, huh? I don't write this stuff. It's the laws. That's the tax laws. So that's the thing that's really interesting about this. One thing I'm going to tell you as becoming real estate agents, you need to stay up on what's going on with tax laws. And you befriend an accountant, befriend your tax preparers, because they can also be good sources for you as business, okay? Good sources for you as business, because things change so fast in the tax code. Tomorrow, I can get legislated out of business, because they can write and say, we're not letting 1031s happen anymore. All right, it could happen tomorrow. Then I'll have to come back and practice real estate. All right, okay. This is a prime example of what a fourplex might look like. You've got a portion of 121 and 1031. The one thing I want you to be aware of if you run into this situation as agents is just because you see 4 units and if it sells for $400,000 doesn't mean that one unit is 100 and the other, that each unit is 100, okay? Because it could go by the improvements inside the property as well as the square footage. So if I have the bigger house, which is my primary residence, and I have 2 units in the back, then those 2 units may be 500 or 700 square feet. Where are you going to put more of the weight of the value? Probably on the primary residence. Where would you want to put it? For sale, definitely on the primary residence. For the investment, you probably want to put it the other way. The challenge is you can't have it both ways. Okay, so you're going to have one treated one way, one treated the other, and your property tax is going to be broken out accordingly. All right. Okay, now to get to this gentleman's question about the basis in the property. Okay, the IRS says, all right, you're not paying me, so there's certain things you can't do. One is you can't get your basis out of the property. That's why I liken it to a latte. They're going to go after the foam first, which is the gain. So you can't leapfrog over the foam and go right to the coffee, okay? So they're going to say, no, if you do not reinvest completely in there, then what I'm going to do is I'm going to tax whatever didn't go into the property. So this is what we fondly refer to as the exchange equation. As real estate professionals, when you're selling a property that there might be an exchange or there's going to be an exchange, your target purchase price for your client needs to be equal to or greater than the sale price of that property. Is that pretty straightforward? Okay, so if I'm selling a property for $900,000, I buy a replacement property for $1 million. My loan on the old property was $300,000. I'm getting a new loan for $660,000. I do have closing costs, which I'm going to talk about. All right, so closing costs are an acceptable part of the exchange. And then there's cash coming out. So all my cash went to the accommodator and is going to the acquisition of this property, and I'm having equal to or greater than debt. So as you can see, my debt is higher than it was, so I replaced my debt, so I have 0 mortgage boot. I spent all my cash, so I have 0 cash boot. So for all intents and purposes, I have a tax-deferred transaction here. Now, if I go down from $900,000 to $700,000, that automatically tells me there's going to be a tax consequence. Okay, automatically tells me that. Where it's going to be, I don't know. It just depends how the client does it. So I have debt of $300,000. I only acquire debt of $260,000. So I went down in debt by $40,000. I obviously didn't spend all my cash, so I had $100,000 of cash not spent. I have a combined boot issue of $140,000. Where people get all confused is they say, why do I have to pay tax on the mortgage? And what did I say in the beginning? What is a mortgage? Cash. It just belongs to someone else. And people forget that little concept, okay? If the situation was where I had no debt on the property and he had debt on his property, if I'm only looking at the cash aspects of this, then why is it I have to invest everything and he doesn't? Because he had debt. See the logic to that? So people go, oh yeah, I get that now, okay? So that's when you see that you've got a situation where you have a combination of mortgage and cash boot. In a situation like this, where they're going this far down, I would sit down with your client and run some, and never give tax or legal advice, but say, based on the information you're giving me, if your gain is $200,000, or if your gain is $150,000, doing an exchange to me doesn't make a lot of sense, because you're going to pay tax on the gain before you're going to get to the basis. So does that answer your question?
Yes and no.
Oh, yes and no. Well, you didn't like the answer.
Investment is post-tax.
Say again?
The initial investment, let's say, like in this example, 1.5.
Mm-hmm.
I buy a property, 500,000 cash, post-tax money.
Yeah, you've already paid tax on it. Mm-hmm.
So then when I sell it for 1.5,
Mm-hmm.
I can do what you said,
Is this in your way?
the 121, the 500,000,
Right.
right?
Well, if you're looking at this situation here, okay. Mm-hmm.
Initial investment, post-tax money, 500,000. I buy it cash.
Well, the question is, he's asking where is this going to get allocated, okay, basically. And we leave that to the tax advisors, because I do not give, I'm not a tax preparer. So how that tax preparer is going to allocate the new basis in this property is going to be up to them. And I know enough to know when I don't know enough, okay? So it's a line I use occasionally, more than I probably like to, but the reality is if I don't know, I'm not going to say it. So you let the accountants figure that out. But the opportunity's there, that's what's important. Okay, all right, and then this is just another example of mortgage boot. Now, different types of exchanges that we deal with. There's the swap, which basically means this gentleman he wants my property, I want his, and we swap. Say all things are equal. In that situation, you do not need a qualified intermediary, okay, because it's a direct swap. We do not get involved in swaps. So he has my property, I have his property, that's a swap. A swap is not a simultaneous closing, which means that I'm selling one and buying the other one within a matter of 24 or 48 hours. In that case, you still need a qualified intermediary. The other types of exchanges, and the one that's most common, is a delayed exchange. Then there's the multiple property acquisition. So sometimes people are going to buy multiple properties or sell multiple properties. There's a reverse exchange, which I'm just going to highlight on. I'm not going to go into that, because if this is a lot, that's even more, because it's much, much more complex. And then an improvement exchange, which is similar to a reverse exchange, okay? Again, more complex. Okay, so when you're doing an exchange, there are certain closing costs that are acceptable closing costs that would not be considered boot. Okay, very important for you to understand this, because sometimes when you guys might be negotiating a transaction for somebody, you might be saying, okay, I want the seller to pay for the points of the buyer or something along those lines. That's a boot issue for your client that's doing the exchange. Now keep in mind, remember, I'm talking about investment properties only, not the primary residence. Okay, escrow fees are acceptable expenses. Legal fees are acceptable expenses. You're happy to know your commissions are also acceptable expenses, okay? Because that's a part of the deal. Title insurance, except for the lenders. My fees are acceptable expenses. Transfer tax, notary, and recording fees. Those are acceptable exchange expenses. What is not? Prorated rents and security deposits. And that gets really tricky when people are buying replacement properties and the sellers are saying, oh, I just want to credit you for the rents and for the security deposits. That becomes a boot issue, because you see the cash is not going to the purchase of the property. Remember, prorated rents is income, and security deposits basically belong to the tenant. Okay, so it's not an acceptable expense. Lender's fees, paying the buyer's closing costs, lender's title deed policy, impounds, property taxes, and insurance. That's all cost of running a building, not buying a building. All right? So it's acceptable expenses and non-acceptable expenses. Now, let's get into how an exchange is going to work. What happens in an exchange, you got a listing, for example, okay? You have a client that's going to be selling an investment property. When you take that listing, you're going to tell them what? You have the potential to do a 1031 tax deferred exchange. Here's the name and phone number of accommodator. Talk to your tax or legal advisor to see if you need to do an exchange. Your client does that, says, yes, I'm doing an exchange. Okay? When you get into escrow, the qualified intermediary now gets involved with the paperwork. We do a lot of talking to your clients before they even get into it. I'm talking to somebody that's been trying to get a deal done for the last 6 months. I'm still talking, okay? Like you, I don't get paid until it closes, all right? So there's a lot of discussion that goes along the way. But once you get under contract, that's when the qualified intermediary gets into play. So our documents must be into escrow and to your client before escrow closes. Before escrow closes. I always recommend to agents that when they've referred a client to me, that they stay engaged in the process. Too many times agents go, it's not my job, man, I don't want to do this. Well, you know what? You need to pay attention because you want to make sure, because you're going to find out, if you're not already dealing with clients, you're going to find out that they don't always read everything that comes from escrow. All right? Oh, I got this big fat envelope. Was I supposed to open that? All right? That's a reality. Same with our exchange documents. That's another, well, it's not that big, but I mean, it's enough. It's like 24 pages. So you want to make sure that you know that the documents have been sent so you can stay on top of your client to make sure that they sign the documents. Okay, so let's say it's a perfect world. What happens is when escrow closes, the deed to the property is going to go to the buyer. The deed is going to go to the buyer. So if you're working with a buyer and the buyer's being asked to cooperate with a 1031 tax deferred exchange, it's really no cost, no liability, or no delay to the buyer in doing so. The reason the buyer is having to cooperate is because when you initially wrote that purchase and sale agreement, the accommodator wasn't the seller. The seller was your client. We now become the seller through our documents. That's why that exchange agreement is very critical. Okay, so once escrow closes, that's when the timeline in the exchange is going to begin. I had somebody that thought that the timeline in the exchange began the minute you opened escrow. Escrow could take 6 months. You know, by that time you've already had to close your property and you haven't even finished the first one. It doesn't happen until escrow closes. Okay, so the closing of escrow. So as real estate professionals, which is really important though, is that once your client gets under contract for the acquisition, you should be looking for that replacement property. Don't wait till it closes. All right, so now the money is coming to me. I'm holding the money. You're going out there and you're buying the replacement property. When you go out there and you negotiate for the purchase and sale of the replacement property, you need to let the seller know you're doing an exchange. Here's something that's very important. I have a slide later, but I'm going to address it right now. If your client is buying a short sale or an REO, it is critical in that initial offering to that lender that you say the client is doing an exchange and the contract needs to be assigned to the exchange company. Because what's happening is lenders are not allowing the assignability of the contract to us, and the deals are not going to close. Because that's very, very important. So when you start your business and you're working with buyers, the question you need to ask your buyers is this acquisition this property you want to buy, is this a part of an exchange? I have too many agents that make people come from other areas that don't ask that question. They get under contract with a lender, and all of a sudden now the exchange company has to come into play, and the lender's saying, absolutely not, because we prohibit that a contract from being assigned, and the deal doesn't go forward. And who do you think they're going to look at? The agent. So please ask that question when you're working with buyers on REO and short sale properties. Very, very important. Okay? Now you found your property. Oh, please, and by the way, let us know that you're under contract on the acquisition. You know how many times people go, well, where's the money? You got to wire it in. Well, we didn't know you were under contract. You know, we're not psychic, okay? You got to tell us. Our documents come in. We wire the funds to escrow. your client gets the deed to the property. Now, as you can see, my little timeline there, you have 45 days to identify, and you have 180 days to complete it. As you can see, the 45 is within the 180. It's not 45 plus. And these are calendar days. That's the time frame for the exchange. That's why it's very important for you guys to understand how long this can go on. It's not forever. It's only 180 calendar days. As agents, if you get involved in an exchange, you have to put on your calendar when does that 45 and when does that 180 days come. Because if the 180 day falls on a Saturday or a Sunday or a legal holiday, you better be closing before, not after. It's not business days, it's calendar days. Okay? And if you have traveling clients, good luck on that one.
Now, is that an absolute 180, or can it be in a shorter time frame?
Oh, okay. All right. I thought you were going to go the other direction with that one. Okay. She says, is that 180 days an absolute? If you really want to make sure that your deal's getting done, the closer to the closings, the better for you. Okay? I thought you were going to say, oh, is it a suggestion? I mean, can I go 190, 182? How about that 45? Is that 45 a suggestion? It's not. It's statutory. And the reality is there's accommodating accommodators. Do not work with accommodating accommodators, because I'll tell you right now, you're helping your client commit tax fraud, which is a felony, and they do not get to pick their roommate. Okay? You will go to jail. There's a guy in Sacramento going to jail right now for 3 years. Okay? Because you're falsifying your tax returns. So that's why planning is very, very important. One of the things that we're seeing in today's market is people are starting exchanges, but they're not necessarily finishing them. If somebody starts an exchange but can't complete the exchange, they've not lost anything other than, a small fee. The tax consequences would have been the same had they just cashed out at the time of closing. But what clients have done, and I had one do this up in northern LA County, sold a property for $2.4 million, decided they weren't going to do an exchange, and then 2 weeks later, after close, found a property they weren't going to exchange into. I said, the ship has sailed and you're still standing on the dock. Okay, it's too late. But at least give yourself 45 days, because you have to at least give yourself 45 days, because that's the minimum that we're going to be holding it for, okay? So, but understand these time frames are statutory. Okay, talked about that? All right. Very quickly, your client has 3 rules to choose from in identifying. And by the way, when we talk about like kind, the other component to like kind, what a lot of people do not understand, is it's only like kind if it's been properly identified. If your client has not identified the property, or they try to buy something that is outside of their ID, it's non-like kind in a 1031 and therefore will fail. Okay, therefore it will fail. Okay, so as an investor, I can pick one of the 3 rules. The first most common is the 3 property rule. I can identify up to 3 properties. I do not have to buy them all, but I can give myself some flexibility. If I don't like that rule and I want to identify more than the number 3, then I fall to the next rule, which is the 200% rule. It says I can identify as many properties as I would like. However, the aggregate amounts of the values cannot exceed 200% of what I just sold for. So if I sold for $1 million, I can identify 6 properties totaling $2 million. Typically, you're not going to find that in this area. Okay? Maybe in Barstow, you might be able to get about 10 houses. Okay? So you see where I'm going with that? So it depends on geographic. And then if I get a little carried away with my numbers and my values, I go to the 3rd rule, which is the 95% rule. I can identify as many properties as I would like without regard to fair market values. Sounds like the best rule. Why is it at first? Why is it last? Because the key here is I have to buy 95% of those values. So in essence, I have to buy my entire list. I like to call that the all or nothing rule. Because if I come short of that 95%, I have a taxable consequence, but I am the proud owner of all those properties, okay? Very important. Very few people do the 95% rule. So these are the identification rules. As agents, you should never take their identification. Why? Because you are their agent and you're not qualified to take it by the law. It has to be given to somebody who is a party to the transaction, but who is not an agent for. So you can't give it to your CPA, you can't give it to your mother, you can't give it to your attorney, and you can't give it to your realtor. You can give it to the seller. You can give it to escrow. Most people give it to the qualified intermediary. But you as agents should never take your client's ID. You should hound them to make sure it gets done, but that's as far as you go, okay? All right, must be in writing, must be unambiguously described. So in other words, if you're buying a condo in a condo project, you can't say the Casa Villa condo project in Pasadena. Okay, which unit? Are you buying 100 of them? So you have to get specific. If it's raw land, you're going to probably give a legal description or an APN number. Must be sent by midnight of the 45th day, and I've already explained who it can be sent to. If we as a company do not receive your client's ID letter, we're going to be on the phone to them. Did you identify with somebody else? No. Okay, your exchange is over. Because after the 45 days, you no longer have an exchange. Please understand that. That's why these time frames are very, very critical. And you understanding how they work are important. Any questions about the ID? Can you start it again? Well, the question is, can you start the 45-day if they see the light? Did they see the light before escrow closed on their relinquished property? Because it hadn't started yet. No, once they close on their relinquished property, that clock goes. There's no redo. There's no, no start overs. You can't say, okay, I get a new 45 days. I didn't write the laws, but I have to comply with them. Yes, sir.
When they identify, do they have to make an offer?
No. Excellent question. When they identify, does it have to be an offer? No, it does not. Probably a good idea to, because you want to make sure whatever you identify. Now, some people might have already made an offer on one property, but they might identify 2 other properties as a backup just in case. You just have to hope that those 2 properties are still there if the first property falls out. Okay? So do you see how it's like tap dancing on a pin needle, okay, the head of a needle. Very, very difficult. That's why when you ask, does it have to be the 180 days? No. Most people that are pre-planning are doing it in a very short period of time. The only time that we're seeing, if they're not pre-planning, is when they cannot get the loan. And that creates a problem. And the IRS is not kind and gentle today, period, and they're definitely not going to be kind and gentle if you can't get a loan. Personally, they don't care. Okay, they don't care. Yes, sir.
Let's say that I'm doing an exchange,
Mm-hmm.
a trade, property for property.
Okay.
And mine is $1 million,
Mm-hmm.
one is 800,000. So I have a good of 200,000.
Right.
Can I do that as a 131 exchange?
Okay, he's asking me if he sells a property and for $1 million and 800, he buys one for 800,000, and then if he can use code 121 for the other 200,000.
1031, I'm sorry.
Okay. Oh, for the other two, so in other words, can you buy multiple properties?
Right.
Yes.
No, but when you're doing a trade, when you're switching properties.
When you're switching
you have
properties.
a building
Mm-hmm.
for 800,000, mine is
Oh, when we're doing a swap.
Right.
No, you got to be careful. You're doing a swap because now our values are not there, so that will be boot immediately. That will be boot. Yeah, because that's different than an exchange. Okay, that's a swap. So in that situation, somebody's going to pay tax. Okay, and if you're the one going down in value, you're the one that's going to pay the tax on that one. Okay. All right. I can tell you in my 9 years with asset preservation, I've seen probably 2 swaps. Very rarely does it happen because very rarely does somebody want somebody else's property. Okay, very rarely. Okay, I can sell multiple properties and I can buy one. I can sell one and I can buy multiple. Just make sure, and I'm not going to go into a lot of detail here because I'm throwing a lot of information at you guys. Are you staying with me okay? Okay. All right. So the timing on multiple property exchanges are very critical. And that's when you really need to make sure that you're working with a qualified intermediary that is going to hold your hand through the entire transaction. Okay? People think that all we do is produce documents. Yes, we do. But that's not all we do. You have to service and talk to the client. And if your answer is constantly from the qualified intermediary, I don't know, talk to your tax advisor, then that qualified intermediary is really not helping you. While we cannot give tax or legal advice, I feel it is my role to at least to illuminate the walkway. I'm going to give your client the questions to ask their tax advisor. I am going to tell them the rules to the exchange. Okay? So not all qualified intermediaries are equal when it comes to knowledge. You have to understand that. Anybody can do what I do. You guys could like the subject so much. He says, man, I'm going to start my business tomorrow. And you can. Okay, he looks trustworthy. Would you give him 10 million? Yes.
In regards to these 1031 exchanges, with the lenders, what large lenders do not lend in regards to these 1031?
Okay, the question is which lenders do not lend on 1031s? They're not lending. It's not. They don't make the loan because of 1031. They make the loan because they don't like the property. They don't like the income stream on the property. We really don't have anything to do with that. In fact, if I was an underwriter, I'd be going, okay, we know we got the cash here. What a lender will do with us is they're going to want to verify the funds we're holding. Okay, and we're going to treat your client's funds the same as a bank would treat your client's funds. They have to get a VOD signed. We're not just going to put that information out into the World Wide Web or on Facebook or anywhere else. Okay, but the lender will ask us for verification of the funds we're holding. Where the lender issue comes in is when you're doing an REO or you're buying from the lender. That's where we have the problems with the lenders. Not so much on the lending side. The challenges with the lenders in 1031s is just any day lending issues today because of the criteria for lending. Okay, does that answer it? All right. Okay, I'm going to talk about a reverse exchange in 30 seconds. It is when you have to close on your replacement property before you can close on your relinquished property. There's two things that are missing in that transaction: the ultimate buyer for the relinquished property and the cash that they bring with them. So how do you buy the property for the reverse exchange? I like to say it's not for the weak of wallet for many reasons. Okay? People say, well, aren't you going to give the money, Dino? I said, we're an accommodator, but not that accommodating. Okay? Now, that's when you're going to have a problem with the lender in a reverse exchange. Because in a reverse exchange, what happens is we go on title. We form an LLC, independent of our company. We're the single member of that LLC. If there's a lender involved, we're going to be signing the loan documents. So when we're signing your loan documents, because we're your borrower now, we're going to say you need to change your recourse language because asset preservation, its parent, and everybody else is not going to be responsible for this loan. Now, you're going to have the borrower can guarantee it. That's totally acceptable to the revenue procedure. But most cookie-cutter lenders are not going to do this deal because we're going to require that they change their loan, they change their criteria. When we've done situations where the lender has, if there's a prepayment penalty in that one, okay, was I psychic? If there's, because it's an issue, and as agents you have to understand this. If there's a prepayment penalty, when the money comes in from the sale of the relinquished property, if I got to finance more because of cross-collateralization, then I'm going to pay down that loan. If all this cash comes in exceeds that 10 or 20% prepayment, then I might have a prepayment. So we would look at the loan agreement and would say, tell the borrower, you need to negotiate a one-time waiver of the prepayment when we come in and bring the money into it. Okay? So it's a very complex transaction. We are doing, actually, believe it or not, the volume for reverse exchanges is up. It's up. So a lot of people can't do it because they need the money from the sale. That's usually your biggest problem. And by the way, the fee for an exchange like that runs $6,000 on up. It's not cheap. It's not cheap. You have double transfer tax issues and everything. But when people are wanting to take advantage of this market right now, and they have to close on that property, they'll consider a reverse exchange. Okay? So they're out there, they're available. If you think you run into that situation, get me on the phone as quickly as possible because you will know whether that's doable or not doable pretty quickly. Okay? Especially when I ask your client where they're getting the money. Because they may not want to tell you that answer, they might give you that answer, but they will give it to me. All right? Okay. All right. Now, in wrapping up, okay, because he's going, he's the hook. So you can talk on this subject for 8 hours, and I'm talking very rapidly, so I'm hoping some of this stuff will stick with you guys. But the one thing that's really important is why would somebody want to do an exchange? And if they want to do an exchange, what's the benefit to doing an exchange as opposed to cashing out and buying another property? Okay, the first thing you're going to want to learn how to do as agents is learn how to calculate gain. So how do you calculate gain? First of all, what was the basis in the property? What was my original purchase price? In my example here, my original purchase price was $500,000. When you have investment property, you might make capital improvements to that property. Put on a new roof, fix a bathroom, fix the kitchen, put in carpeting, okay? Put it on a garage. That all gets added to the basis in the property. So let's just say that's $50,000. When there is investment, when you have an investment property, you get this one lovely thing called depreciation. Depreciation is a non-cash expense which lowers your real estate taxable income. It also lowers the basis in your property, okay? It's called allowed or allowable. So if your client is not using depreciation, when they calculate gain, they will have to. Okay, so they're not taking advantage of it. So now I subtract. So here we go. I bought it for $500,000. I put $50,000 in capital improvements. I depreciated it by $150,000. My net adjusted basis is $400,000. Now I'm going to calculate what's my gain. So I'm going to take, what did I sell the property for? Well, I'm selling a property for $1.2 million. So I'm going to subtract my net adjusted basis of $400,000. I'm going to subtract my closing costs because that's an acceptable expense. So say it's $80,000. My capital gain is $720,000. Does anybody see loans in that section? Because loans have absolutely nothing to do with gain. Loans have nothing to do with gain, and I can't tell you how many clients think it does. Okay? It has everything to do with purchasing power, but it has nothing to do with gain. All right, so let's look at my tax ramifications. Depreciation has its own tax rate of 25%. 25% of $150,000 is $37,500. Federal long-term capital gain is 15% right now. So my federal tax rate is going to be $85,500. State of California is going to be $67,000. I'm just rounding it up. My total federal and state liability potentially is going to be $190,000. You think that's going to raise a few hairs on the back of your client's neck? Okay. All right, now let's talk about their purchasing power. So we've got the sale price of $1.2 million. We have a closing cost of $80,000. We do have to pay off that lender because lenders like to get paid off when the property is sold, okay? So they're going to get paid off the $300,000. My cash coming out of escrow is $820,000. If I decide to just sell and pay the tax, but I still want to be in real estate, okay, but I'm going to pay the tax, I'm going to have to hold back $190,000. I'm not even going to get into 3 1/3 withholding issues, all right? But that's just basically a prepayment of your state tax. So my cash now after is $630,000. If I take that $630,000 and I go out and I buy a piece of property, I'm leveraging it, you know, at 65% loan to value, my ability to buy will be $1.8 million. If I do an exchange, which means I'm not giving the $190,000 to my hidden partners of Uncle Jerry and Uncle Sam, I have $820,000 to spend. And the same loan to value, I can buy 2.3. That, ladies and gentlemen, is the power of an exchange. And by the way, which commission is higher? Okay. All right. So you got to start thinking commissions. All right. So you can see that's why people do exchanges. Here's the thing. When I defer my gain, it's as though I have an interest-free loan from the IRS. When I finally decide to cash out, that's when I will pay the tax. If I pass away and my heirs get the property, they do not have to pay any of the tax, capital gain tax that I have deferred along the way. Okay? They'll have to pay estate taxes potentially, okay, but not the capital gain tax. All right? That's the power of the exchange. Okay, I'm going to just skip through this because we're running out of time here. Okay. I talked about the pitfalls, about REOs and short sales. Installment sales is another issue. I was at an escrow office yesterday, and an agent was working with an installment sale. Is everybody familiar with an installment sale? Where the seller that's selling the property is carrying back the paper?
Oh, yes, yes, yes.
Okay. All right. So there's still 3 1/3 that has to be withheld. And who has to send the money into the franchise tax board? The buyer. So every month, that buyer that has that installment sale with that seller is going to be sending 3 1/3 into the franchise tax board. I will tell you right now that can potentially kill a deal in escrow because the buyer's going, I do not want that responsibility because if they miss it, they're the ones responsible. Okay? In this transaction, there wasn't enough cash coming out. There was actually no cash in the deal. Now, how's it going to close if that buyer decides that they're going to pull out of the deal? Okay? The seller doesn't have the cash, so they're going to have to bring in the cash for the 3 1/3 withholding. So you have to work these things when you're going to learn the net sheets. You have to start understanding when there's little cash in a deal, how are you going to get paid? How the franchise tax board? And believe me, if that money is not there to go to franchise tax board, escrow is not closing. Escrow is not closing, and they're going to be coming to your commission. So know these things up front. Know these things up front. So it's very important working with very seasoned and experienced escrow officers. Okay, treat them with respect and like you want to be treated. Those people can really help you through your transaction, or they can sink you. All right, befriend an escrow officer. Okay, we talked about that, and right now the estate tax is 35%. Last year it was 0. Who passed away last year that you can remember? A big name? No, Michael Jackson died in 2009. But short memory. It's like he's alive today. George Steinbrenner? New York Yankees? 0 to the government. Yes, okay. But the heirs didn't get a step up in basis, all right? So, but now the estate tax is back in, 35%. They wanted to kick it back up to 55, okay? But your estate has to be $5 million or more. So these are some of the things to be aware of when you're dealing with individuals that are selling. Planning is very, very important. Okay, talked about that. When you are working with the client and taking a listing and it is not their primary residence, there's certain questions I think you should add to your level of questions when you're talking to clients. All right, 1, how are they holding title? You're going to get a profile or maybe even a prelim from your favorite title company, right? And you're seeing the title. Okay, Joe and James, or John and Paul, because we'll just say it's 2 guys that own the property together. Tenants in common, 50-50. And you stop there, right? You don't have to ask any more questions. About the title. All right, they're doing an exchange and they're going to come to me. I'm going to say, how are you holding title? John and Paul, we both have 50% interest. Okay. Are you filing this separate? Or you file a 1065K, 1065 and get K1s? And they go, oh, we file a 1065 and we get K1s. And you see the difference between the title and the tax reporting? One says they're an individual. The other says they're a partnership. In my world, the tax return is what prevails, not the title. And that's why it's very important for you as agents, because one of the situations I dealt with, it was on title the same way, but they were filing 1065s and getting K1s, and they didn't want to be together. Okay, very important to know this up front, because then you can deal with it while you work with the thing.
That situation happened, so I had a transaction that happened like that recently,
Okay.
and got denied
Uh-huh.
like that.
Yeah, you're on the loan side.
Yeah.
Yeah, see, I'm coming from the exchange side. Yeah, I mean, they don't want to be together any longer. They want to sell, but they want to go their separate ways. Well, how long have you held? Minutes, seconds, and hours after you've asked title to escrow to drop it out of the partnership and put it in your names? That's not going to, that's very high risk, extremely high risk. Okay? So, yeah, so these are issues. It's very important to ask those questions. How are they reporting it? How long have they owned the property? Was this... When they acquired the property, was it a part of an exchange? This is something that is a question that you really need to ask in today's market. Because you might be looking at listing a property, say, for $1 million. And you go, oh, well, they bought it for $1.2 million. There's a loss. They don't need to do an exchange, right? And you just stop there. You should never stop there. The question is, did you acquire this as a part of an exchange? Because if they did, remember what I said earlier, the basis goes with you. So if they deferred $500,000 worth of gain on the prior transaction and they lost $200,000, they still have $300,000 of gain to defer. Very, very important to ask that question, because if they make the assumption that my basis is what I bought it for, they're going to end up with a very, very big headache if it's not the case, all right, when they see their tax person. And so are you going to consider any seller financing? Do you have competent tax or legal advice? Very important that your clients dealing in real estate have tax advisors that understand real property, because the IRS is now making it an issue to go after investors on their Schedule E's. They're going to be checking to make sure that that roof truly was not added as an expense. All right? This is a capital improvement because you can't have both. You cannot put a roof as an expense on your Schedule E unless you were replacing a shingle. But if you're putting an entire roof, that's a capital improvement, has more than a lifespan of a year, and therefore doesn't get written off the year you spend the money. I know it stinks, but you get to add it to the basis when you sell, and also you get a new depreciation because of that roof. The IRS is going to be looking at people that have investment properties, and they're going to be comparing the expenses. So be aware, they're beefing up. I tell you, kind and gentler is no longer in their vocabulary, and they're going after it. And then, are they considering a 1031 tax deferred exchange? My favorite subject. All right. Okay, qualified intermediaries. Not all of us are equal. We are not regulated from the federal level. We are, however, regulated from the state level. And it has about as much teeth as a newborn baby. Okay, do you have a prudent investment policy? Okay, what does that mean? Define prudent. Okay? Very, very, very loose regulations. So, understand that we hold your client's money. So, questions you're going to ask. In whose names are the funds held? There was an exchange company in North LA County. If I say NAMVAR, does that name ring a bell to anybody? If you read the LA Business Journal, probably sometime last year, you probably saw that name quite a bit, NAMCO. Okay, NAMCO had an exchange company called NAMVAR. Would you like to be investing your money into NAMCO and knowing that that same company was holding your exchange proceeds? Because guess what happened to the exchanges? All right. So, doesn't tell us where we have to put the money. Remember, prudent, whatever's prudent. Okay, so you have to be careful. So where are the funds held? Are there any requirements for the deposits or the withdrawals, any of the movement of funds? Where are the funds held? Is it held at a bank that has a signed company on a Friday afternoon outside in the parking lot? A little dangerous, huh? You know what I mean by that, right? FDIC is now taking them over. All right, is the qualified intermediary audited by an independent third party? Does somebody come in and audit what the qualified intermediary is doing? Is the qualified intermediary insured by a larger parent company, and will they put it in writing? All right, so these are very important questions to ask because we are holding your client's money. I always am shocked when people say, what's your fee? That's the first question that comes out of their mouth. What's your fee? Okay, my fee is $350 for the sale, $350 for the purchase. We're very reasonable for what it is we do. But if you're, well, I'm going to the guy on the internet, it's $400. Okay, where's the guy on the internet located? Yeah, Cayman Islands? So you have to be careful who you're dealing with. So make sure you ask these questions. Okay, and like I said, there's no federal oversight of what we do. We were put into the Dodd-Frank Act, but we don't know what's going to happen with that. That's like 2 years out. They're still trying to figure out what they wrote. Okay, and that's above and beyond the health care bill. Okay. There's marketing tools on our website you can use for when you start marketing to investors. You can go in there, customize the handouts. I'm just showing you some stuff. You saw some examples of them in your packet there. So if you ever decide that you want to start marketing to investors, our company allows you to go ahead and use our templates if you'd like to do so. All right. Any questions? No, I need a drink now. Yes, sir.
We're talking about depreciation. It's not book depreciation, right? It's actual depreciation? You deducted like 25% for depreciation.
Okay, the depreciation tax rate is 25%.
Not book, actual depreciation?
Depreciation, but when there's boot, okay, the depreciation is going to get calculated first, and then it's going to get to the other portion, okay? So boot is when somebody does have boot, yes, that is going to be a computation to the tax liability to the boot. Did I answer your question?
Yes.
Very good. Any other questions?
I suppose that it's up to the agent to hook up you and the escrow people and the representative for the other party. How does that work?
Okay, who hires a qualified intermediary? Is that what you're asking? Okay, well, it could be either you as a recommendation. It could be some people leave it to escrow. Some people leave it to their clients. Okay, as real estate professionals, what you probably do is say, here's a couple of qualified intermediaries. that I've worked with and have confidence in, talk to them. And then once you talk, you make sure that the discussion goes on, and then once they've talked, then if you say, yes, they've chosen your company, Dino, we want to work with you, I'm going to say, okay, what's your name? Roby? Okay, so I'm going to say, Roby, I need to name who's handling your escrow. I need the file number, and I need the property address. I'll be making the call to the escrow officer, and then I'll request the documents that I need. And I'll say, Roby, do you want to be, I will say this, not every qualified intermediary, do you want to be CC'd on the documents when we send them out to your client? You say yes. You do not have to do a thing with it. It's going to sit in your inbox. I don't care. But they've been sent. So when your client says, I don't know what happened to them, you can print them out. Okay? Escrow's going to get a copy as well. I just highly recommend you guys stay engaged in the process. All right? Because it helps you with the next transaction. Because now you can talk the language better and faster. And you got it all going. You got a system going. So that's what we're going to do. So we're going to get the information that we're going to need from escrow. And we're going to ask, I'm going to say, escrow, I need a copy of the prelim, the PSA, the purchase and sale agreement, and the escrow instructions. I don't do the documents myself. My headquarters does. And so my headquarters is now going to contact your client. And I'm going to have a nice email passing them off to my people saying, here are the exchange counselors, here's their contact information. Feel free to contact any one of us if you have any questions, because I stay engaged. My people aren't there on the weekend, but I'm always available morning, noon, and night, okay? So in that situation, that's how we pass it on. That's how we do it at our company. All right, so if your client says they've chosen their own QI, you say, who is it? So you know what qualified intermediary you're working with. All right, so you at least have that. And you're sort of out of the picture if they've made the choice. Okay? Any other questions?
One last question.
Sure.
Who keeps the interest accumulator?
Ah, very good question. Who keeps the interest? Every accommodator is different. Because if I'm charging $350 and $350, you think I'm making money? We make our money on the interest. Right now it's more of essence of interest because the interest rates really stink. Okay? Our company, we share. We share the interest. Some companies do not give any interest at all. Some will give interest after a certain period of time. But right now, it's truly more essence of interest. I mean, you're looking at maybe a half a point if it's over $1 million. Okay? That's how bad, yeah. What are banks being charged? Zero. Yeah. They don't have to pay much to get money in. I mean, that's just the nature of the beast. But to keep one thing in mind, people don't do exchanges because of the interest they're going to receive. This is deferring the taxes. And they will be 1099, by the way, for that interest. Okay? Any other questions? All right, well, thank you for allowing me to be here this afternoon. And success to you all.
Thank you, Dino. Take a 10-minute break, and then we have a short sale speaker next, so a quick 10 minutes.